The screens inside the Treasury's secure auction room are already bleeding red. No cameras, no speeches, just rows of traders, backs hunched, eyes locked on a wall of numbers that refuse to move. Scott Bessant, once called America's top bond salesman, walks in. He's seen tough auctions before, but this feels different. The 3-year note sale is minutes from closing, and the lifeblood of these deals, foreign bids, has almost vanished. Outside those walls, another headline explodes across Bloomberg terminals. China's 10-year government bonds have just fallen to a record low yield of 1.7%. For decades, that number wouldn't have mattered much in Washington. Today, it's a flashing warning light because America's own 10-year yield is 4.28%, more than double. In global finance, that's not just a gap, it's a shift in gravity. Cheap money wins wars without firing a shot. And right now, Beijing can borrow for decades at rates the United States hasn't seen in a generation. Bessant knows what's coming next. The auctions aren't just sales anymore, they're trust votes. And this summer, too many of those votes are coming back stamped no. The warning signs were there before the first gavel even dropped. When the Treasury rolled out its 3-year note sale, the expectation was simple. Foreign buyers, the lifeblood of these auctions, would show up in force. They always had. But that day, the indirect bidders category, a polite term for foreign central banks and sovereign wealth funds, barely moved the needle. Their participation hit the weakest level since 2023. This isn't just a statistic buried in a PDF, it's oxygen leaving the room. Without those bids, the US has to rely more heavily on domestic banks, hedge funds, and primary dealers to soak up supply. And those players aren't charities. They demand higher yields, more return for the risk of holding American debt. The next day, the 10-year auction, the market's crown jewel, was supposed to stabilize the mood. Instead, it detonated it. Bids came in thin, and yields actually rose during the sale. That's Wall Street's way of saying, if you want us to take your debt, it's going to cost you more. By the third day, the 30-year auction arrived with the weight of history on it. This is the maturity that defines a country's long-term creditworthiness. And it crumbled. Foreign demand slid to its second lowest point in 5 years. Traders didn't just take note, they started treating Treasury auctions the way they treat volatile corporate earnings calls, potential risk events that can whiplash prices in minutes. For decades, U.S. debt sales were the dullest thing in finance. Now, they're becoming adrenaline-spiking moments where the question isn't how much will be bought, but whether enough will be bought at all. And for Scott Bessant, sitting in that secure auction room, the pattern was undeniable. In just 72 hours, the United States had gone from the undisputed gold standard of global credit to a borrower forced to sweeten the pot just to find takers. That kind of reversal isn't just about numbers, it's about reputation. And once reputation cracks, markets never forget. This wasn't a case of China simply missing the auction calendar. This was a calculated, methodical pullback, the kind you plan quarters in advance, not days. Treasury Department data shows it in black and white. Beijing's holdings of U.S. government debt have fallen to about $756 billion, the lowest point since the aftermath of the 2008 financial crisis. And it's not a blip, it's a trend. Month after month, they've been net sellers. Where's that money going? 3 places, each with a strategic edge: gold reserves. Beijing has been quietly stockpiling, knowing that when trust in paper assets wavers, gold becomes the ultimate insurance policy. Domestic banking system. Instead of sending dollars back to Washington, China is fueling its own credit markets, keeping capital inside its borders. Belt and road loans. This is the real game changer. Chinese banks are issuing U.S. dollar loans overseas to African, South American, and Asian governments at interest rates lower than what Washington pays to borrow its own currency. That's not just competitive, that's humiliating. Bloomberg calls it an inversion of credit hierarchy, a phrase that wouldn't have existed in serious finance 20 years ago. It means the old assumption that the U.S. sets the standard for safe borrowing is breaking down. And China isn't alone in moving away. Japan, still the single largest foreign holder of treasuries, has slowed its buying as domestic yields rise, making it more attractive to keep money at home. Middle Eastern sovereign wealth funds, flush with energy revenues, are steering billions into infrastructure, technology, and commodities, sectors where the returns easily beat the locked-in yields of long-dated U.S. bonds. The shift is quiet but brutal. Every dollar redirected away from treasuries is a vote of no confidence in America's fiscal trajectory. And unlike political polls, these votes are backed by real money. For Washington, this is more than just losing a customer. It's losing the world's most reliable repeat buyer, the kind that used to show up to every auction without fail. When they walk away, others start wondering if they should too. When foreign buyers step back from your long-term bonds, you're left with 2 choices: pay up to keep them interested, or change the game entirely. The administration chose the latter. Instead of locking in expensive 20 or 30-year debt at today's elevated rates, the Treasury has shifted heavily towards short-term Treasury bills, debt maturing in less than a year. On paper, it's clever. Short maturities mean you're not stuck paying high interest for decades. You keep the near-term cost of borrowing down. But in practice, it's like living on a credit card that you have to pay off every month and hoping the interest rate doesn't go up. Here's the reality. Over the next 4 quarters, 9.2 trillion in existing debt will mature. That's 9.2 trillion the US must refinance in the open market, and most of it was originally issued when rates were much lower. Add the 1.9 trillion in new borrowing to cover the deficit, and the total refinancing need soars above $10 trillion. And remember, that's happening in a market where foreign appetite is shrinking. The data makes it plain. Foreign custodial holdings at the Federal Reserve are down 48 billion since March. Reverse repo positions, another form of short-term funding, have dropped by 15 billion. These aren't signs of investors rebalancing their portfolios. They're signs of retreat. The problem is structural. Short-term debt comes due quickly, forcing the US to constantly roll it over. That means every few weeks, Washington is at the mercy of the market's mood. If global investors demand higher yields, the Treasury has no choice but to pay them, instantly increasing the cost of financing government operations. History offers a warning. In the early 1990s, New Zealand relied too heavily on short-term debt and saw borrowing costs spike almost overnight when foreign investors balked. It took years and painful budget cuts to restore market trust. For the US, the stakes are even higher. The sheer scale of refinancing required means that even a small increase in rates can add hundreds of billions to the interest bill in a single year. That's money that can't go to infrastructure, healthcare, or defense, because it's going straight to creditors. In short, the short-term debt gamble might buy time, but it also makes every auction a cliff edge, and the higher you pile the debt, the steeper that edge becomes. In theory, U.S. Treasuries are the safest investment in the world. They're called risk-free for a reason. They've been the foundation of global finance for over a century. But the markets are sending a very different message right now. Investors are demanding a higher return to hold U.S. debt than to lend to countries with far less economic history and far more political control over their markets. That's upside down. And in finance, that reversal has a name, a trust premium. It means the United States now has to pay extra, not because its economy is weak, but because its political climate is unstable. The spectacle of repeated budget standoffs, debt ceiling threats, and trade wars has a cost, and it's priced directly into every auction. You can feel the ripple everywhere. Mortgage rates are stuck above 6.5%, despite 3 Federal Reserve rate cuts this year. Why? Because mortgages follow the 10-year Treasury yield, not the Fed's short-term rate. And that yield won't come down while investors keep demanding more to hold U.S. debt. Auto loans? More expensive than at any point since the early 2000s. Credit card APRs? At record highs. Municipal bonds? Cities are paying millions more in interest just to build schools or repair bridges, and those extra costs fall directly on taxpayers. And then there's corporate America. Refinitiv data shows U.S. investment-grade bond yields are running nearly double those for comparable Chinese state-linked issuers. That's not just embarrassing. It's strategic damage. It means U.S. companies are paying more to finance their growth, which tilts the playing field toward foreign competitors. Over time, that shifts where factories are built, where jobs are created, and where global expansion takes place. This is the danger of a trust premium. It's invisible until it's everywhere. It doesn't require a financial crisis to start hurting you. It's death by 1,000 cuts. Slower growth, higher costs, weaker competitiveness. All because the world no longer assumes you're the safest bet in the room. While Washington is juggling auctions and scrambling to plug gaps, Beijing is quietly playing a very different game and winning it. China's inflation is flat to negative, giving its central bank the luxury of cutting interest rates without sparking a consumer price spiral. That alone is a powerful weapon in global finance. It means they can make borrowing cheaper at home and remain attractive to foreign investors seeking stability. The People's Bank of China still has room to maneuver. Every basis point it trims off borrowing costs makes its debt more appealing, not just to domestic buyers, but to international funds looking for a safe anchor in turbulent markets. And in real terms, after accounting for inflation, Chinese bonds now yield more than U.S. bonds. That's a stinging reversal of the traditional order. The yuan has also held steady in 2025, backed by a trade surplus and strict capital controls. For foreign investors, that's critical. A stable currency means low nominal yields still deliver solid real returns. Contrast that with the U.S. dollar, which has slipped against a basket of major currencies since early summer. quietly eating into the returns of overseas Treasury buyers. Then there's the Belt and Road Initiative, China's trillion-dollar global infrastructure play. Its overseas loans often come with interest rates between 2% and 4%, comfortably undercutting the U.S. Treasury's own borrowing costs. Those loans don't just build ports, railways, and power grids, they buy influence, long-term contracts, and political goodwill, all without deploying a single soldier. Meanwhile, the U.S. is on track for a historic first, spending more on interest payments for its debt than on national defense. Think about that. The world's most powerful military, outspent by the cost of keeping creditors happy. In pure strategic terms, that's the difference between playing offense and playing defense. China is using its financial breathing room to expand influence and lock in future trade routes. The U.S. is using its borrowing just to service the past. For decades, the U.S. dollar wasn't just the dominant currency, it was the default. Trade in oil, global debt markets, international banking systems, all ran through the greenback. If you wanted to play in the global economy, you needed dollars. But in 2025, that grip is loosening. The IMF just confirmed it. The dollar's share of global foreign exchange reserves has fallen below 59%, the lowest in decades. That number might sound abstract, but in the world of central banking, it's a flashing red light. It means countries are actively diversifying away from the dollar, holding more euros, yen, and increasingly Chinese yuan. Across Asia and the Middle East, central banks are building out local currency bond markets. The goal is simple: reduce dependence on the dollar for both borrowing and lending. Why should a Saudi company building a port in Africa need dollars if it can settle the deal in rials or yuan? This isn't just theory. Trade deals between China and Brazil now routinely bypass the dollar, settling directly in yuan or reais. Russia sells energy to India in rubles and rupees. The United Arab Emirates recently signed agreements to clear certain commodity trades in dirhams. Even in the heart of the financial system, U.S. Treasury auctions, the shift is showing up in market mechanics. Futures tied to Treasury prices are experiencing unusually wide bid-ask spreads during auction weeks. Translation: liquidity is thinning. When fewer buyers step in, it costs more to match sellers and buyers, and that extra friction drives up yields. Primary dealers, the Wall Street firms obligated to buy treasuries when others won't, are now holding more unsold inventory after auctions than at any time since 2016. They're being forced to discount positions just to clear them, the kind of fire sale behavior you never want to see in the world's safest market. De-dollarization isn't about replacing the dollar overnight. It's about slowly building systems where the dollar isn't required at all. And every time another country settles a deal without it, the U.S. loses a little more leverage and gains a little more competition. In finance, you can debate politics, you can spin narratives, but you can't argue with the flow of money. And right now, those flows tell a story Washington doesn't want to hear. In the first half of 2025, emerging markets excluding China saw net inflows of about $84 billion. That's impressive, but China alone attracted $120 billion. For a country that just a few years ago was bleeding capital during the post-COVID slowdown, this is a stunning reversal. Where's that money coming from? A lot of it is leaving the United States. The same period saw a net outflow of nearly $35 billion from U.S. long-term securities. These aren't day trading shifts or short-term speculation. These are big, institutional reallocations, the kind of moves pension funds, sovereign wealth funds, and global asset managers make when they're repositioning for years, not months. It's not just who's leaving, but why. Higher yields in the U.S. aren't enough to compensate for political drama, budget brinkmanship, and the perception that the U.S. is losing fiscal discipline. Investors would rather take a slightly lower yield in a market where the rules feel predictable, even if that market is halfway around the world. And the fallout is visible inside the auction room. Primary dealers, those obligated to mop up any unsold treasuries, are ending up with more leftover inventory than at any time since 2016. That means they're being forced to unload these bonds later at discounts, locking in losses. For a dealer, it's the financial equivalent of getting stuck holding the bag. Every dollar that flows out of treasuries into Chinese bonds, Middle Eastern infrastructure projects, or emerging market equities chips away at the U.S.'s central role in global finance. It's not a panic exit. It's a slow, deliberate rebalancing of the world's portfolio. And once those allocations shift, they're hard to reverse. Because here's the truth: capital is loyal only to returns and stability. And in 2025, for the first time in living memory, the U.S. is struggling to offer either at the premium it once commanded. Back in the Treasury's secure auction room, the glow of the monitors paints the faces of traders in pale blue. Numbers flicker, bids trickle in, and the silence is heavier than any market crash bell or trading floor shout. Scott Bessant leans forward in his chair. He's been in this seat for years, across administrations, across crises. He's weathered the 2008 meltdown, the European debt scare, the pandemic liquidity freeze. But this feels different. This isn't panic buying or panic selling. This is absence. The next batch of bids appears on the screen. Smaller, thinner, costlier. The kind of participation that says, we'll help you out, but you're going to pay for it. It's a quiet negotiation, but one where the other side knows exactly how much leverage they have. Bessant understands the symbolism. The United States built the global financial highway, the infrastructure, the systems, the trust, and for decades, everyone else drove on it. But today, America is paying a toll just to use its own road. And Beijing's 1.7% yield, that's not just a statistic in a bond trader's spreadsheet. It's a statement, a declaration that the gravitational pull in global finance is shifting eastward, and that the shift is already underway, not a distant possibility. This is the kind of transformation that doesn't reverse quickly. Once investors, sovereign funds, and central banks rewire their strategies, they don't unwind them on a whim. And as those allocations and trade routes solidify, the world's financial architecture begins to look different. Bessant knows the truth that few in Washington want to say out loud. This isn't a temporary blip in auction demand or a market tantrum over interest rates. This is a structural change in how power is measured. And the currency of that power isn't just money, it's trust. And in global markets, trust is earned slowly and lost all at once.